Hi, it's Eric Nuttall of the Ninepoint Energy Strategies for a weekly update. There's no shortage of things to cover. I'm going to try to be as brief as possible. We had the US government enact tariffs on Canada, Canadian oil at the amount of 10%. This was not our base case. We had thought that logic would prevail. The US government would realize that this is a complete cost pass-through to the US consumer. There is no alternative to Canadian energy, Canadian oil specifically, as we export over 4 million barrels per day to the United States, 3 of which goes to PADD 2 refineries, so kind of the Chicago area, where there is no substitute. And so what we have seen reportedly is gasoline prices going up anywhere from 15 to 20 cents a gallon already. Very clearly a cost pass-through, very inflationary, very obvious, noticeable and apparent as people drive up to the pump and fill up their car. And roughly a 16-cent increase per gallon on an annual basis represents over $20 billion hit to U.S. discretionary consumer spending. And so there will be immediate impact. We do not expect tariffs on Canadian oil / Canada to last for much longer. And I think there are unintended consequences that are occurring from this. We feel increasingly confident that as this a very direct attack on Canada's sovereignty, it is cementing the understanding of just how critically important the build out of further pipeline capacity is in Canada. Premier Danielle Smith gave a speech yesterday. She called it our trump card as a country. We used that term about a month ago in a column for the Financial Post. We believe that as Canada builds out further pipeline to circumvent the United States Gulf Coast to access other markets, that will reduce our dependency very clearly on the United States. And it's interesting, there's a lot of skepticism, and for some reason, about the ability to build pipe to the east. There's been some softening on the part of the Quebec Premier. But West Coast, there was a filing, the Financial Post did a great job of identifying that the TMX expansion was actually supersized to allow a northern leg to access Kitimat, which with export capacity of roughly 400,000 barrels per day. If we remove the above ground obstacles, the C69s, the 58s, the gender-based analysis on pipelines, et cetera, there's some belief that we could build that within a year. And so this is not a pie in the sky dream. And we're hopeful and we're optimistic that more and more Canadians, more and more premiers are seeing what we see, and that is Canada, we must build out further pipeline capacity. As we look at the carnage in the stock market, we've seen oil sell off. Some people are attributing that to the OPEC Plus agreement to start slowly, methodically returning barrels to the market beginning in April at about 130 to 140,000 barrels per day per month, so very gradual. OPEC Plus went out of their way, so the voluntary members of that deal went out of their way to say, well, this is market dependent, we're going to be adaptable, subject to market conditions, et cetera. And we've seen oil price sell off. We think part of the reason for that is the broader market, the tremendous amount of uncertainties that we all have to deal with, the volatility, which is nausea-inducing and crimping one's neck, et cetera, the way we felt in a couple of years. But that's creating a massive opportunity, which we're going to touch on in a moment. There is a huge disconnect between what we think our reality is, what we believe to be true, and what we're told to be true. What we're told is U.S. shale drill, baby drill. We're told that demand is weak. We're told that OPEC Plus, they're worried about loss of market share, and that's why they're going ahead with all of these things. I just left a meeting with my favorite analyst, Matt Portillo from Tudor Pickering, talking about shale companies. We're talking inventory degradation and forecasts, coming down, et cetera, for growth and all these different things. And then I return to my desk and I see Secretary Lutnick on CNBC talking about, I just caught the end, and he goes, well, we're going to drill, baby, drill and bring down the oil price. And so there's just such a massive dislocation between what we think our reality is and what we're told on a daily basis. And I would strongly encourage you, don't believe what you hear, believe what you see. Official data clearly demonstrates that U.S. shale last year grew at its slowest pace since its inception outside of COVID. Mother Nature, geology, capital discipline will trump anything that the White House tries to enact. And we are now at the death zone for production growth. $65, $66 WTI means zero growth going forward for U.S. shale. And so again, we speak to the law of unintended consequences. When we hear about, OPEC plus faltering cohesion and all of these different things, this is going to sound like a permeable spin on this. What we model, we've put up on Twitter, is even assuming OPEC plus voluntary members go ahead with the return of supposed 2.2 million barrels per day over 18 months. When we look at days of supply, the historical relationship that has to price, it's still suggestive of a Brent price of about $80 between now and the end of 2026. So let's just go there for a moment. OPEC plus goes ahead, voluntary members, etc. What does the world look like in a year and a half's time? We will have, by our estimates, eliminated more than half of OPEC's spare capacity. They'll be down to less than 2 million barrels per day in what will then be roughly 107 million barrel per day market. We will be, I think, on the cusp, if we're not there already, in terms of peak US shale production, and by extension of that, peak non-OPEC supply growth. So a year and a half, 2 years time from then, what does the world look like then? We think the demand for oil will continue to grow for many, many, many years to come at lessening amounts, but still, anywhere from 800,000 to 1 million barrels per day. We will be at a point, again, in a year and a half time, roughly, where we'll be at peak non-OPEC supply growth. OPEC will have brought on, OPEC plus voluntary members will brought on the majority of their OPEC spare capacity. And so where beyond that point do the necessary barrels come from when we've lost short cycle supply, US shale, let's call it 9-month cycle time. Now we're relying on long cycle where it takes anywhere from 5 to 10 years to bring those barrels on. That is what we think our reality is. But what we're told is, drill baby drill, the world's awash in oil. We're going to head to $50 because that's what Trump wants, etc. So this disconnect between what we think are fundamentals and reality is just massive. And so the impact that is having on investor psychology, the desire to invest in the sector, stock valuations is profound. 2 days ago, we've seen a bit of a recovery the past couple of days, but when we look at relative strength index, so the amount of the degree of how much stocks are oversold, we reached the lowest point 2 days ago versus, you'd have to go back to the COVID era when we were like negative oil, biggest demand shock in history, etc. That is how negative the market is. When we look at, 52-week lows, there were 25 energy stocks hit 52-week lows on that day, and it was almost twice average daily volume. And so it feels like we're reaching, or we've reached the point of capitulation. Very clearly, anybody that has wanted to sell on tariff concerns, I've done my best to explain how it's a very muted impact on cash flow, but we think that selling has occurred. Worries about the global economy owing to global tariffs, all of these different things. It feels like we've seen the worst. And so what has that selling led to? In our estimate, in our opinion, energy stocks represent a very compelling opportunity. I want to give some very broad examples without getting specific because I get into trouble by doing so. And so when I look at the top holdings in our fund without getting specific, we have a name where we think they have 25 years of stay flat inventory in the Duvernay and the Montney. They're trading at, we estimate, at a 14% free cash flow yield at $70 oil. We have a company with 35 years of stay flat inventory in the oil sands. This has been just slaughtered. It's now trading at a 14% free cash flow yield. They'll buy back over 10% of their stock with a very strong balance sheet. We have a company we were adding to earlier this week. They have over 50 years of stay flat inventory in the oil sands. They have no debt. In fact, they've got over $100 million of net cash. They're trading at about a 12% free cash flow yield, and they're buying back stock on a daily basis. We have a Montney producer, a big weight of ours, trading at a 12% free cash flow yield at $70 oil and $4 gas. We've got a large cap that just reported they put up a good quarter, trading at a 12% free cash flow yield at $70 oil, returning the majority of that free cash flow back to us. We have a liquids-rich Montney producer. They reported this week as well, trading at 3 times cash flow, 12% free cash flow yield over the next 5 years. They're going to grow their production by 50% in free cash flow, about 80% of their current market cap. That's down like 18% year to date. We've got a name we were adding to, it's down roughly 18% year to date. They have exposure to over 20 years of stay flat inventory in what we estimate to be one of the most economic oil plays in North America. They're trading at a 19% free cash flow yield at $70 oil, and they're returning the vast majority of the free cash flow back to shareholders. And so we believe that, and the reason why we remain bullish on Canadian energy stocks specifically is that it feels like we're at the point of maximum pessimism. Only time will tell on that. We think there is a strong disconnect between the fair market value for oil versus where it is traded at. We think the oil price is sold off on broader macro, on confusion around what the gradual potential return of OPEC barrels means, and most importantly, hearing about the president, Secretary of Treasury, etc., talking about drill baby drill. It feels like, because every time on CNBC every day you get a generalist investor being asked about energy, and they're like, well, why would we invest in that when we hear for it can be rising production and $50 oil? Meanwhile, reality shows you that U.S. shale last year grew at its slowest pace since its inception, excluding COVID. And so I know the volatility is nausea-inducing. Times like this are uncomfortable, very, and that's massive understatement. From our experience, we've been doing this for over 20 years. It's in times of maximum uncertainty where you get maximum opportunity from our estimation. And so we continue to remain bullish on the outlook for energy stocks. It's our intent, and what we've been doing is taking advantage of the sell-off, adding to key names where we see where we believe to be a strong disconnect between what we think fair value market is and where we trade today. And so synopsis, and this is a little more than the typical 5 minutes that we target, but there's a lot to cover. We do not believe in the mantra of drill baby drill. Reality, logic, and math simply do not corroborate it. We do not think the return of OPEC plus barrels are nearly as bearish as the market believes. And in fact, we heard some rumblings about investors are now starting to look at oil specifically, not just because of the bludgeoning year to date, but because now there's a timeline and visibility towards it no longer being as much of a managed market. We've seen natural gas. We don't even have time to touch on that. We've got large exposure to natural gas, where names we've got strip for the next five years, very, very high levels. If weather cooperates this summer, we see the potential for next year where the market is simply short, where we could get a significant spike. And so that bodes very, very well for natural gas producers, obviously. So there's this disconnect, fundamentals, reality. Our desire is to take advantage of that. And so that's a wrap. With so much more to cover, but this isn't intended to be a long diatribe. So thanks very much for your time, and we look forward to another update next week.